Hey everyone, welcome to another deep dive. It's been a while, but kind of special guest in that he's a longtime friend, Nate. Welcome, Nate.
Thanks,
Um,
Nick.
yeah, so I guess we're just gonna kick it off. Um, so you run what Eat Sleep Crypto. Um, or
Yeah.
what's the name of the company now, I guess?
Token Dynamics. Yeah.
Token
So Eat
Dynamics.
Sleep Crypto was the glorified blog that I ran for like 6 years, where I was writing and still write my insights on mostly token value accrual, fundamental value, incentives, and like the state of crypto broadly. And now we've got Token Dynamics, which is the firm that I run that does protocol design, economic security, and tokenomics in every sense of that word.
Yeah, and that's what it's kind of changed a lot, and that's kind of where we can start. Maybe you can give us like a little bit of a history lesson here, because tokenomics, like it's a semi new concept, but it's like its meaning is vastly different than it was 5 years ago. Um,
Yeah.
so like,
Yeah.
what was kind of the history here? And like it started with Bitcoin, where it's just fixed, and then we just moved. Yeah, I'll pass
Yeah.
the floor over.
Yeah. Great way to start it. Great way to frame things. So, tokenomics, the word tokenomics has been like the bane of my existence for a long time. And the semantics and the meaning around it, has changed so much. And it's still like it's consolidating a little more toward just the simple term of like tokenomics. But there have been at least five different terms for, what this discipline is. If we're going from like Bitcoin and moving through like the Bitcoin forks around 2012, 2013, I think tokenomics might have started to become a term around then. I don't quite remember. 2013 was when I got into the space, but tokenomics typically has referred to like the supply, allocation, and distribution of a token. That was like the original um, use, and I think still is the most popular use. And when you think about like when people think about the word tokenomics, they're thinking about supply, allocation, and distribution. These three things. So like how many tokens are there? Where do they go? And how do they get there? So is it an airdrop? Is it mining? Is it like these different ways of getting a token out? Those are like the so like the traditional uh, meanings of tokenomics. But what we've got now, people have called like token economics, where they're thinking about the incentives and how to get people to use a protocol or to get people to take certain actions in a protocol using the token. And this is what I started to call a couple of years ago demand side tokenomics, to distinguish it from what I call the supply side of tokenomics. And and these two complement each other. You have to have demand to match supply, and that is the thing that I noticed around 2018, 2019 when I started writing about this topic, that was like sorely lacking. People were saying, this is after the ICO bubble had burst. Everybody had this idea of like what who you give a token to, and like what kind of incentives there would be to get people using a protocol, but very few people had thought about how the token is used in an economy, particularly in ways that both cause it to accrue value and um, don't compromise the incentive structure of the protocol itself, or like feed into the incentive structure and create positive feedback loops that you would want in a protocol. um, and so they're starting to describe what are the three principles of demand side tokenomics. These are protocol utility, value accrual, and economic security. And I'll pause here briefly because I've just said a lot of things and I want you to direct the conversation anywhere you think it should go.
Yeah, no, I mean, I always think of it, like you had the past where like Bitcoin does it actually really, really well in some ways, so like whether it was like intentional, I'm guessing it was intentional,
They
but
had no competitors. So like
right. So,
they had a blank canvas, right?
but so you basically create this asset, but then it also like by setting the rule that we mint every 10 minutes, then what happens is that this bootstraps security for the network. Because the question
Mhm.
was always, how do you sort of incentivize people to spend boatloads on hash power to make this thing secure? And it's like, well, we'll, mint tokens. And this is an example of like a supply side tokenomics. And then, and these were like the base, the early models all sort of had mining in it because everything had mining back then. And then later we like sort of moved to Ethereum with tokens. And then people realized like, oh, wait, like we actually don't need mining. We can just basically print the entire supply right at the beginning. And so like we can print the entire supply right at the beginning. And then everyone was like, oh shit, what do we do with these things? Like, do we just give it all to the team to sell? Well, that's probably not a great, this looks very much like a stock. Just passing it, and this is equity. And it's like, oh wait, like we can actually maybe use it to like Bitcoin. You can incentivize security, you can incentivize liquidity, you can do all these things. And it's just been this whole path of trying to figure out what to do with these as so you basically mint to this token that's like meaningless and just digitally created out of thin air. And it's like, how do you sort of incentivize a community to build around it? And like you had like the early liquidity farming and stuff like that. But then the problem there was, as you've talked about, like any sort of sustainability is like really, really hard to get with any of this stuff because you can incentivize it for a short term and then everybody just dumps. And
Yeah.
and then there's regulatory problems as well with a lot of fees being accrued and things like that. So yeah, I mean, what like I guess we can just walk it through. Like nowadays when people are talking about they're going to launch a token, well, what are the usual things that you have to walk them through, and what would even be recommended, and what would have been the lessons we've learned so far?
Yeah, well, a couple things you mentioned, like one of those is the legality of things. I think that's screwed over the discipline of tokenomics. It's done a great disservice to people who want to launch tokens because they're thinking more about how to like raise capital without being deemed a security than they are thinking about how the token should actually move in their economy. And so they end up with something that looks like has kind of the downsides of both a stock, or doesn't have the same benefits that a share of stock has, but also has like the downsides of what a token, the constraints of a token, because it'll have governance rights and not much more. So when I first hear someone is launching a token, I assume it's a pure governance token, and that's a whole thing that we can get into later. But the the legalities around issuing a token have complicated the industry a lot. Bitcoin didn't have to deal with that, and so it had an open canvas for that reason, a blank canvas for that reason, but also it had a blank canvas on the supply side because it's like, why every 4 years? Like why every 4 years? Why every 10 minutes? And there were some reasons behind that. Definitely with the 10 minutes, like you've got latency and um, but generally the numbers that Bitcoin picked were arbitrary, and that was fine. And some of its competitors improved on that. Like Monero came along in 2016, I think, might have been 2014. Kryptonite came around, but the Cryptonote, the and Monero picked different parameters, right? And that still worked because there isn't anything else that was doing. There wasn't anything else that was doing the demand side things that Bitcoin was doing, which was being a medium of exchange. And so Bitcoin actually got, the supply side, it did fine. But the demand side was excellent because Bitcoin was positioning to be the money of the internet. It was positioning to be a peer-to-peer electronic cash system. And that generated the necessary demand for Bitcoin to meet these three principles of tokenomics that I've started to call the tokenomics trilemma: protocol utility, value accrual to the token, and economic security. And Bitcoin's value accrual and economic security, well, all three of those things were dependent on the demand side of Bitcoin, the demand for BTC to be used as a medium of exchange. That was the usefulness of the protocol utility. That was the way the token accrued value, because a medium of exchange has to be worth at least as much as the things that it's paying for. It's axiomatic. And the economic security of the network. Bitcoin has to be valuable in order to pay miners to secure the network and provide hash power. And so it was doing those with the demand side mechanism. And so this is why I tell founders the supply side is important and you want to not screw that up, but you have to get the demand side right. It's much more important for the longevity of your protocol to have the demand side of tokenomics correct, and check these three boxes of the optimizing for the tokenomics trilemma. So I forget your original question, but that was the thing that I wanted to riff on.
Yeah, well, I mean, I would say demand almost is, for most people who are in the space, like you can recognize that the demand piece is what's usually missing. Like there is no shortage of tokens.
Yeah.
Like tokens come out of thin air. It's just how do you actually get people to pay attention to it and use the thing.
Right. Yeah, I can pick it up.
Yeah. So go for it.
Sure. Yeah. So this reminded me what I wanted to say, which is I think the role of a token now, or the role of a token economist, is to find a way for a token to be used in a protocol that is defensible. And so by defensibility, I mean, defensibility is made up of like economic moats. It's like ways that your protocol can have a sustainable competitive advantage. And I think that is the primary role of token economists now, because to the a lot of detractors will say, like, why do you even need a token? Why can't you just use Ethereum or Bitcoin? And that's a valid criticism. I tend to say the question is not like, why do you need a token? It's, can you use a token? Because if you can, you're much more likely to succeed. And but to do that, you need a sustainable competitive advantage. You need to have defensibility. And so like defensibility properties might be intrinsic to the protocol, but they could also be secondary. So for example, like Uniswap has a really strong brand that causes it to, and uses its treasury in a way that has people build on them. And so they're integrating into protocols and like building some defensibility into their protocol by getting people to like enshrine what they're doing in whatever protocol they're building on. So that's getting people to build on top of your protocol is a way to build defensibility. Uniswap doesn't have a native token that's particularly useful, but that is an example of a protocol that has done defensibility well. And so I think that's like an important role for token economists right now. And that's like one of the primary concerns of tokenomics and optimizing the use of a token in a protocol these days.
Yeah, well, I mean, like, I guess we can just go right there with Uniswap, and we'll just jump into it. Like, because like most of these things, you can say like it does look relatively similar to Uniswap, right? Like a lot of these apps, like whether it's your own chain or like, do we want to use Uniswap or an Oracle as an example, like, or like a bridge?
Depends which way you're going with it.
Yeah, no, I mean, like, what, even like let's say you have like a bridge, you want to start this bridge network. You need some token and you stake your token, and then you can bridge people's assets and you can get slashed if they, if you force something bad through, you have this token that's up for sort of slashing. This is like a classic, the token is this middleman layer that, and this is like, whether it's an Oracle, a bridge, or, some other exchange chain, it'll have a token that you use for staking, and then you run and you can get slashed if you lie. And this is like a very common model that you see, as far as like, oh, well, we need the token obviously for staking, with which, ignoring that, like what is, I guess, the token used for then? Like what is the purpose of this? What is, because like most of the time, like what I would argue would be that the token is basically like you're trying to incentivize creating a network because you have this small company of people who's trying to go break into, say, the bridge industry. There's lots of bridges out there and we want it. So we want to break in. So we're layer zero or one of these other people that want to break in. Uh, if we can get a whole bunch of people to start using our bridge for maybe the future token launch coming, they're going to basically bootstrap that. Or we launch a token and people start using our bridge because it will accrue value to a token that they hold. It's like basically this mechanism for like it's in real economics, it's like what the infant industry arguments. You're like sort of actually helping these tiny little companies to succeed against a larger competitor. Um, so like is that the basis of it? And then does it start there and then transform into more of a fee paying security? Is that the goal, I guess you could say?
I think that's been the trend. And
Yeah.
I think that's been the trend because there is more room to build defensively when you capture less value. And so I see three TradFi analogs for tokens, and those are currency, commodity, and equity. So a token can be currency like, commodity like, or equity like. And what we started out with in crypto was Bitcoin, Litecoin, Feathercoin, Dogecoin, all these. And there were things before that, but that were standalone currencies. But the idea was like, let's build a money and what makes money good. And so these were currency like mechanisms that were tried first. Like you notice there weren't a lot of people building DAOs, and that's partly because the smart contract scripting wasn't fully there. And like there are other reasons for this, but people first jumped to currency in creating tokens because that's what accrues the most value. And it's still like the first article I ever wrote on Eat Sleep Crypto was a valuation of Bitcoin if it were to replace Swift and just Swift, the interbank transfer network. If Bitcoin replaced Swift, it would be worth something like 100 million of today's dollars. And that's just between banks. Like that's not used as a medium of exchange. And we're talking about Bitcoin, the asset, not Bitcoin, the network. But if Bitcoin replaced the dollar in Swift, it would be worth 100 million of today's dollars. And that comes from an equation called the equation of exchange. Milton Friedman popularized this, but it goes all the way back to John Stuart Mill. And the idea is that a currency is worth what it pays for, divided by the number of times that it's used to pay for something in a given time frame. MV equals PQ. And so currencies capture a lot of value. And Bitcoin's major opportunity was to be the money of the internet. And that was what was fueling not only the speculation around Bitcoin in the early days, but that's what I believe caused the Silk Road run up. Like the initial spike to like 1400 in beginning of 2014 was from Bitcoin's use as a medium of exchange. And we're starting to see the same thing with Monero because Monero has recently been pulled off of exchanges. And so the price is starting to float freely. I think there's a good chance that it's going to run up the same way Bitcoin did. I talk about this on Doug Tuman's Monero Talk podcast in January. So if people are interested, they can look at that. I won't go into it too much further, but currencies capture a lot of value. And so people started capturing value with currencies to their tokens. That shifted a little bit to commodities when
Well, I mean, the problem with
tokens,
Bitcoin replacing Swift is like technologically
scalability.
Yeah, like it can't actually.
And we could rehash the
Right.
block wars debates, right? But that was I think the original idea. Like if you look at Satoshi's writing on Bitcoin Talk, he would talk about like the vending machine idea, and Bitcoin could scale to be like he thinks it'll scale to be a few large data centers. Anyway, So the next trend though for value capture to tokens was or value accrual was to build things that looked kind of like commodities. So Ethereum is that, right? It's like oil. And I hope that they position to be a currency because oil for block space, especially when blobs exist and data availability is sourced off chain and L2s are the roadmap for scaling. Oil is not that valuable in this context. So I hope Ethereum continues to push for ultrasound money for its own sake. But Ethereum was like one of these first utility tokens. And then you had a bunch of other tokens that were being built on top of Ethereum in the ICO boom, where people were saying, we are the native, we're launching Substratum. Do you remember that this one? They were saying they were going to be the like sort of a on-chain internet network VPN sort of thing. And they had a token that was native to them. That was one that I thought of because I always found it the most fascinating. But let's use a more popular one, like Golem. Golem was going to have a utility token that powered their compute network, right? I think that was
What are they
GNT's
called
original
nowadays?
use. What's that?
They're still around. They're called something different nowadays.
Really? I didn't know that. I thought they
Yeah,
were
I got a sticker from them. I think they were at ETH Prague, and I was like, "Oh, you guys are a new project," and they're like, "No, we just were, yeah, Golem rebranded," and I was like, "Oh,
they've still got something like $400 million
I
in
know."
ETH that comes up quarterly on my timeline. Someone's like, by the way, there's still 400 million of sell pressure waiting to hit from Golem's ICO. Um, that yeah, those that was an example of a utility token that resembles a commodity. And so there you're capturing a little less value than you would as a currency if you're saying like one of these tokens price, you can price, not pricing the services in dollars with those tokens, but pricing a service in those tokens. So if you were to say one GNT represents like one loop of compute or like represents one amount of space in the smart contract execution, like
Well,
that would be, yeah,
this was like the popular thing back then. Like it was like the utility token. So
right.
like, if Denta coin, for instance, like we're going to be the coin that's used to pay for all dental services. And then you have
Dentist.
like this
Well,
monetary
yeah.
oil like premium that this is what fuels the network and funds it.
And that's so what I'm trying to describe is the difference between that and an actual utility token. So a real utility token would be like a Pac-Man token, where you put one Pac-Man token in the machine and you play a game of Pac-Man. So the commodity is a commodity is something that has pretty predictable use, and you can get the same amount of electricity roughly, and that increases over time from a barrel of oil, right? And that's how you can view a commodity. And so that's what I think a true utility token would be. There are not that many of those because the utility tokens, even in the earlier days, most people were saying, this is our utility token. And it wasn't as bad as it is now, but they were, the utility token was really just a currency for their smaller island economy. And so they were capturing value in the same way that a currency does, but for a smaller total addressable market. So there were a lot of these tokens that were sort of in between currencies and commodities. They were currencies, but for a smaller ecosystem. I'm trying to think of some tokens that really resemble utility tokens, and I'm drawing a blank according to this definition, but I think I might have explained the high level well enough. The idea is that a commodity like token is something you use one of, and you get a predictable amount of an output.
Well, that's the idea. But then even like if you look at ETH, it's not necessarily how people ever actually used them.
Right. Right.
This is the problem in crypto in general. You can try and design a perfect token, even say like an Oracle token where like you're going to use this thing to stake and earn rewards and secure a network. And it's like, no, I'm not. I'm gonna buy it on a centralized exchange. This thing goes up in value. And like
Mhm.
99% of the pressure for buying and selling is right in that context. So
Yeah,
it's like you're designing tokenomics against this headwind of, yes, massive
right.
speculation.
Right. And so in keeping with that idea and this trend, the third type of TradFi analog that tokens tend to resemble are equities. And they can do that in a couple of different ways. I have an article in Eat Sleep Crypto called The Hierarchy of Value Capture, and it talks about how, like what we're talking about now, there's sort of a descending um, trend in value capture in crypto where things are becoming less and less able to capture value defensibly. And the third is like equities, and that could look like basically that currently looks like the two properties of shares. You've got the right to dividends, or the right to the assets in the case of liquidation, where tokens represent their represent voting rights to a treasury that could be liquidated potentially if they voted to do that. But in most cases, unfortunately, people have descended and jumped all the way to the bottom of the value capture hierarchy and given people voting rights, but to nothing important. And this has posed a bunch of economic security problems that hamper the longevity of protocols that have these pure governance tokens. So um, the most recent example that I'll use is Compound. Compound had a pure governance token, and it was just used to vote on stuff, and it's supposed to, like in theory, have claims to the underlying assets, but it doesn't. And so you had someone that was able to come along and purchase, like get a majority of the voting power, and then threatened to liquidate the treasury to him and his coalition. And this is the kind of thing that has happened many times and will continue to happen for tokens that are not accruing value. People, I tweeted about this yesterday, people make this mistake of thinking that governance tokens accrue value. And Jacob from Zora actually articulated this in his article on hyperstructures a couple of years ago. I wrote a rebuttal to it that's also on Eat Sleep Crypto. But he said governance tokens accrue value because of the threat of the fee switch, the idea that they could be valuable if they wanted to, and like they could turn on the fee switch. But that doesn't quite hold. And so in a similar way, people make this assumption that governance tokens accrue value in order to secure the protocol, or in order that the treasury that they're protecting or that they have the rights to doesn't get liquidated. But that's a reversal of causality. It's actually that the tokens that don't accrue enough value or that are not priced highly enough have already been bought up to liquidate the treasuries of the protocols that they're supposed to govern. And so we've seen several examples of this in the last 4 years in DeFi. One of my favorites was Build Finance. There were a couple $1 million in the treasury of this protocol, and they tried to rally all of the token holders, and they weren't able to. They had like 5 days where someone put a proposal forward to liquidate the treasury to themselves, and they were all over Twitter, and they were like, guys, we really need to vote against this thing because otherwise this guy gets all of the treasury. And they weren't able to do it. So unfortunately, this community watched their wealth get completely liquidated. Like they weren't able
But I
to
don't.
do
I
anything
would have
about
to
it.
argue. I don't think it has to do anything with the token not accruing a fee. Like these things are just these are just honest majority assumptions that are just, this was like, I'm sure you saw
Yeah,
the talk. I'm sure you saw the talk I had with like Edmund Edgar. Uh,
yeah, yeah, all of them.
yeah, I mean the basics is like, if you actually have a decentralized network, you can just, if the token value is not high enough to secure any sort of basket of goods, then then it's going to get bought up and attacked. And even if it is semi-high, if there's any external bribes, you can just basically, convince people to do it. Like it's in their game theoretic best interest. Like, and if it's
Yes.
super decentralized, what you would say is like, like let's say everything is decentralized and anonymous, you would just basically say like, listen, if you vote for this proposal, like I'll pay you out a portion of the treasury. If you don't vote for this proposal, you don't get anything. And then you just have to convince them that you have the votes, or you may have the votes, because I mean there's no penalty for you voting for it, obviously. So like it's in your best interest then to vote for it, because you either get money or you just it doesn't pass and you don't lose anything. So
Yeah.
it's like these things are just super bribable, and they're just insecure. I mean that's kind of what I wanted to ask you about next. Like how much of this, because like most of the reasons that a lot of times you add in these governance layers is like it's actually that like you need to upgrade these things. Like you
Mhm.
have a system and you're shaking your head and you can get into it, but like you
Somewhat. I know, because
yeah,
we have
like
this debate all the time.
you need to, if you have like let's say you're a system and you want to have any sort of permanence, you
Mhm.
need to have the ability to change over time, whether you're Bitcoin or
Sure.
Ethereum or anything. And so like you need to add in basically a token for voting on it.
Yeah,
Um,
if you want to last forever. And I think there are different mechanics that you can use. I want to put a bow on the last thing we were talking about, which is the descent down the ladder of the
sure.
hierarchy of value capture. And we jumped from currency, commodity, equity. At the bottom of that is governance rights. And so my point there is at either end, I won't go into. Okay, to put a bow on this, there are, if you don't optimize for the three principles of tokenomics within this tokenomics trilemma, utility, value accrual, and economic security, and you're overweighted toward one of them, there are going to be issues for the protocol. At the extreme end of not capturing value, you have risk of your protocol getting taken over. Like if you have governance or something like that, you don't want to you don't accrue value, then it's susceptible. To your point, you can use other mechanisms to prevent that. We'll talk about mechanism design and how it in these different topics. But on the other side, if you capture too much value and try to accrue value to your token too aggressively in ways that are fundamentally insecure or create too many price dependencies, you're also vulnerable. And so, at either extreme, um, it's a hazard to have like imperfect optimizations within this tokenomics trilemma, which all protocols have. Like I can name a protocol, and if I know it, I can explain how it fits into this trilemma and start to draw that out. But I would like to go on to talking about different mechanisms you can use. Like we're starting to move toward intersubjectivity and things like that. So
yeah, no, please continue. Because I mean that would be the next question. Like, do you need a social layer for this stuff to work? I mean,
yeah, yeah. So I think um, for social layer creates like air gaps in the same way that centralized oracles can create air gaps to purely economic vulnerabilities. Um, and so I don't know in the same way it kind of it breaks composability a little bit. And so that's like there are trade-offs. But yeah, you could use intersubjectivity and forks and these mechanisms at the cost of these other properties that we value in DeFi.
yeah. Well, I mean, it isn't necessarily a property, because like and now I guess we can get into the question like is economic security a myth in general? Like, well, because like back to the bridge example. So like let's say you have a bridge and you're trying to secure. Okay, I'm bridging my tokens from one chain to another.
Mhm.
Theoretically, like for my bridge operator has money staked and he can lose it if he lies. Just
Mhm.
super simple bridge model. He would need to have more money to lose than is locked in the bridge. at the very least, right? And
Mhm.
if your bridge operator is say a governance token where it's like 51% can vote on what to do, he would need to have like the value of that token would need to be basically double, so over 50% higher than the amount locked in the bridges, right?
Mhm. And it
And
would have to be the liquid value of those assets.
which is crazy hard. And so like what a lot of people would do then would say like, well, okay, what we should do is we use restaking or shared security or something like this, where like, listen, Ethereum validators have hundreds of billions staked. They can then be our bridge operator because they would never ever lie. And I'm sure there's different issues with that, but that would be like the idea is you just want to bootstrap economic security out the wazoo so that way you can do it. But
Yeah. Then you
um,
have capital inefficiency. So they're again
super big
trade-offs.
capital inefficiencies, right?
Right.
But then the basic way that you can do it like with like a social layer would just say like, listen, like if we're our own chain over here and somebody says like, oh, the bridge operator lies, we just revert those changes on our chain. Like all the people
Mm.
running the node say like, sorry dude, that actually didn't happen, go to hell. And because like we can all just see it's one of these faults that like it's very visible what is happening. It's not like he has to be secret about it. It's
Mhm.
very obvious he's stealing money. So we'll just say like, no, we're going to ignore him, and we'll push it to the users to do that.
Mm.
And I mean, this is even like what Ethereum would say. Like, if like, why would no one ever steal 2/3 of Ether? And assuming it is really really now it's really really expensive, but you would never actually do that because people would just revert it. Like we all of us running
Yeah.
would be like, no, no, you actually didn't double spend, dude.
And it has similar security properties to what Bitcoin has in this sense that Satoshi wrote about in the white paper, which is like an attacker or validator miner should find it more profitable to honestly contribute to the network. There's a clause in there, and it's like you don't kill the goose that lays the golden egg kind of thing. And Ethereum has that with like because ETH is an endogenous asset to the chain. The assumptions break down when you have exogenous TVL. And that's the challenge that people are trying to solve in different ways that I don't think intersubjectivity fully solves. And we can talk a bit about eigenlayer or restaking and why that is um, Terra with extra steps. But there's a lot of yeah, that's an important point to make is that works. You can fork away if the assets themselves will fork with you.
yeah. Well, you would need the assets themselves to fork, right? Is the problem.
Yeah, exactly. And you could right. And even if you do that with like a wrapping, then you like does the asset come with? It's like you have to actually have provenance of the asset in a sense to be able to do that and use those kinds of schemes.
Yeah. Well, I mean, back, I guess, to you are the issuer of the token.
Mm-hmm.
You are the person giving life to this provenance, to this token. Like, how should you design it so that way your system is actually secure? Should you say like try and keep it siloed in your system as much as possible and try and like because even like for your DAO and everything like that is what you tell people like don't take in external assets as much as possible and give control of token governance to these external assets because
Mm-hmm.
that's a bad idea and is can be broken or yeah, I mean, how do you handle it?
Well, there's a lot of different. There are trade-offs, and there are a lot of different ways to handle it. So I don't claim to have like the perfect protocol design template. I don't think one thing fits all. It's kind of like a threat model. Like you have, uh, it might make sense for some people to like live on Signal and like not use the internet, but like not everybody needs that level of privacy and security. Similarly, for the threat model of a protocol, like not everybody has to be completely Oracle-less by design if they're okay with the trust assumptions. And importantly, that the protocols that they want to interoperate with have the same trust assumptions. It's kind of like all assets on Ethereum would, as an example, all the assets on Ethereum would suffer if Ethereum itself had some kind of existential crisis or existential problem. Um, so it depends on like the threat model of the protocol. I'll go into a couple of things that I have in mind here. Actually, can you restate your original question?
Oh man, I don't know. We're beyond original questions now.
Yeah.
No,
No,
so
just the most recent one.
yeah, no, I mean it was just kind of on crypto economic security in general. And I think that's a valid answer as far as like you need crypto economic security if you want it just makes ease of interoperability in a lot of ways. Um,
Yeah, and I guess the one of the things that makes it hard for me to answer this question is I don't know how how far protocols can go, like how many levels they can secure things with a chain of economic assumptions. Because while the information is there, the only people that are going to find it are like risk managers and like hackers, exploiters that are trying to find the way to break the chain of links that are economically secured. And so I mentioned earlier that intersubjectivity and trusted oracles are a stopgap, like an air gap. There are others that you can introduce, but most of the time they break composability in some way. And so, but one trend that I think we are likely to see is the rise of like super mechanisms that are. I think money Legos was incorrect. Like the thesis that everything would just build on top of each other composably. That only works if, like I mentioned, the protocols have the same threat model and trust assumptions. It doesn't hold for protocols that have like, you can only build a tower so high, I guess. And so if you're looking at if we're using the analogy of money Legos, like you could have an 8x2 at the bottom, but then you can't have a 9x2 on top of it. You can't have, like, for example, perps that exceed the volume of or that exceed the OI of spot, because then you can manipulate the spot asset profitably to gain at the perp layer, unless you have something like your perp protocol and you have an account that only that is like has a time delay so that you can't flash loan, and that makes the attack cost higher, or like, at least not free through a flash loan. Doesn't fully prevent it. You could also have like a centralized like auditor or a group of oracles or like governance that is optimistically flagging like whether something should be released from the custodial account of the smart contract. Like that would be another air gapping mechanism that allow protocols to work with a degree of economic security or the degree of security, but also introducing like sort of centralized trust assumptions.
Yeah, no, I mean, I've always found the money Lego theme to be really tough to swallow in general, because you would always have like, well, this protocol has USDC underlying it, and then the next protocol up has, honest majority governance token assumptions with questionable distributions, and then the next token up has two centralized oracles, and so you're like, so you build on top of that whole stack, and you're like, man, this is
and you inherit all of those trust assumptions.
Yeah, and there's a whole bunch of problems. And then even if you didn't, even if you go back to the let's say it's all completely immutable, like just smart contracts on top of smart contracts, then you're just inheriting so much smart contract risk. It's like,
yeah,
like you would never, like, you can't even audit all of it because it's so huge.
Yeah, and you'd have to pay like 100% APY for anyone to justifiably touch the smart contract at the top of that pyramid.
Right, and like what you would do at the top of the pyramid is basically to make anyone feel any sort of comfort using it, you would just say like, fine, well, we'll implement a centralized layer that allows us to revert
Mhm,
things
mhm.
if
Right,
necessary. And then
right.
you go back from there. So I mean, like, yeah, it's super, super hard. So like if it's not money Legos, like, do you like the idea of like launching on these other chains, or do you like the idea of like making your own chain with base token assumptions, or like how do those pieces sort of fit together?
I think there will be a couple trends. One of them, I started to talk about super mechanisms. So, like, instead of building with the money Legos, I think people are going to fuse them. Um, and one early example we see of this was Hoyu, who you had Yogandas on your podcast on this deep dive series. It was great. Everybody should go watch that. We did some economic security analysis for Hoyu, and I was really impressed with the mechanism. They internalize their own oracle for the lending market, and they reference the lending market's liquidity to determine, or the AMM's liquidity to determine whether they can lend out more of an asset. And they process all liquidations they before they allow a trader to trade through the AMM. So there's this kind of complex interplay between these two mechanisms, but they synthesized a way to use both. And it allows degens to leverage long meme coins as long as there's liquidity on the DEX. That's what I think the main value proposition of a mechanism like Hoyu is. But this is an example of like a sort of a fusion of money Legos. And so I could see people starting to design more things like that so that there are less layered trust assumptions, less trust assumptions that are built, on 5 different protocols up the stack. And instead, like maybe protocol at the bottom has one trust assumption, and then a protocol built on top of that has another trust assumption, but it's not layering in a way that while the information is available, it's kind of opaque because people can't actually parse like where the trust assumptions are. So I think that's one approach. The other approach is to just have things be more simple and not stacked quite so highly in these Jenga tower of smart contracts. Jenga towers, like it's. So I have more to say on that, like ways that I think that could go. But the trend I think is toward fundamental value in uh, crypto and less speculation being built in to our protocols, and like less assumptions that speculative valuations will always be there. I think, and that's why I started writing about this 6, 7 years ago, was because I saw that eventually the crypto bubble would pop, and protocols and their tokens would have to be valuable in order for them to be secure and to work. And so that's sort of the future I think we're headed toward. We're not there yet. And it's fun to play in DeFi while we're not, because the exciting things that happen are because somebody messed up trust assumptions, or somebody else figured out a really great way to create highly profitable trading strategy, large arbitrage opportunities. So yeah.
Yeah, no, I mean, yeah, to kind of, I got a couple more questions and we can wrap it up. Like the
No,
idea.
I'm in no hurry, but yeah.
Okay, cool. Yeah, I mean, the idea too, like you keep talking about actual value, but that sort of goes directly contradictory to this last cycle, which was
Mm,
pure meme coins.
yeah.
Like it was basically like tokenomics, let's throw it out the window. Let's just launch a dog with a funny hat coin. Um,
Yeah.
but then people, like you ultimately had people, whether it was like, Iggy Azalea or other people, the Trump coins, like they were saying that these would actually make a meaningful difference. So, like they have some underlying good to them as far as like, listen, we're actually going to build a community out of these. And maybe this would be like the meme coin story would be like, listen, we're going to launch this meme coin and we're all going to rally around this meme and actually coordinate action and go do something. Um, is that useful in any way in any of this, or does, because it's like it sort of stands directly opposite to the everything is financialized and balanced out on the payments.
Well, I think certainly Iggy Azalea's token had some importance and meaning to her. It made her, I don't know. One thing that surprised me is how little money celebrities would launch a meme coin for, and then rug it. Like, I think they were just letting a guy launch it for them who rugged it on their behalf. But still, not not a lot of utility even to them. But the meme coin craze, the operant, I don't know, mechanism or principle there is like people are playing low float games, like or low float high FDV was a term that came up on the timeline a lot. It's like there are a lot of these tokens, but only a few of them are traded. So they're thinly traded, easily manipulable, and it's basically like musical chairs. People are playing this game in with meme coins and with other coins in crypto, where they're pricing the assets as if there's like infinite demand, as if there's like a flat demand curve, when really there aren't. And so a lot of economic security problems arise from this. This is, by the way, it's called the mark to market. This is mark to market accounting. I call this the mark to market fallacy because it's a stupid heuristic that we've borrowed from TradFi as a way to inflate the value of the things that we say we own. That's what they do, and they do it for some other reasons. But the this applied to meme coins creates an entirely predatory dynamic where you have like 1% of people able to exit or less able to exit a meme coin, and then the rest of the retail is just holding the bag. And this is what we call a rug when it happens all at once. But we call it a community when it's over time. And at some point, the community falls apart because everybody individually decides to take their share of the rug. And meme coins aren't the only thing this happens with. This happens to the degree that there is speculation built into a crypto or a cryptocurrency or token's price. And so the solution to this, I think, is building protocols that are fundamentally valuable, where the claims on the they might have claims to the treasury and like real yield or something that is at least more liquid. That is like an equity like fundamental value accrual mechanism. But you can also have currency like fundamental value accrual. It's going to be based on those things that have a really strong network effect that are actually used as currencies, like Monero. But you can do that, and so I do see. And one of my main areas of interest actually is in the emergence of Monero-based DeFi. One of my mutuals on Twitter, a guy that I really like, CNode, colluding node, is tweeted today about payments, and he said like the biggest next step for DeFi is to increase payments. Like the biggest increase in the growth of DeFi would come from increasing payments. And he didn't elaborate. But when I see that, the reason I think that is so important is because that's where actual value is being created. You can only capture value proportional to what you create, what value you create. And so we're talking about like fundamental value coming from the use of a token, the most value that you can create and the most value you can capture is from using a token as a currency. And so I see like a future DeFi being built in a similar way to TradFi, which is like on the revenues of real protocols or the interactions of real people with an actually useful financial system. And the only place or the main place that I see that happening right now, I mean, we have cross-border payments, and that's a whole meme in itself. But we also have Monero being used as a sizable proportion of darknet market volume where currencies are used. It's over 60% of transactions are happening with Monero instead of Bitcoin now.
Yeah, no, but I mean, I think once you actually start to get it, like I think we've had this problem with, like with any sort of network in crypto, in that like the original idea was like, oh, we have tokens and they're going to incentivize you to stay in a community and you're going to get rewards and this sustainable yield over time. And they've actually done the complete opposite, right? Like instead of getting you to stay in a community, it fractures communities because it's way more, like you and I, like, do we want to go pour our time and hearts and minds into Monero or some other coin? Or we would probably make a whole bunch more money if we just go launch our own coin, right? and we
Right.
fracture it a little bit, and even if we get fraction of the percent of whatever the other network has, we make more money, and then everyone does this. And so like it all just like, since there is so much speculation, it's so much better to launch the next Trump coin than to actually just go be a part of a community. And
Yeah.
and that's, yeah, it's something that I don't know necessarily how we fix it in this.
Well, yeah, Vitalik said something like he made a call at ETH Prague to be a part of a community. Don't launch the next dog coin. And I was like, and then on the other side, at the fireside chat that he was in, Amir Taki was saying, no, you need to capture value. And I was actually more on Amir's side, because developers, especially developers like Amir that are building things that are actually important that governments don't want to see happen, are like at real risk, and they need to capture value and create their own token, and accrue value to it. I don't think everybody does, but to an extent, we're relying on people that are more motivated than purely profit oriented, and I think that's okay, because I think what we're doing right now in DeFi, while the sun is still shining, is collecting those mechanisms that can work in an adversarial environment. And those, most of the people that have been on your deep dive series actually are the exact kind of people that are building mechanisms that work, that aren't profit oriented. And so I look to those protocols, and it's a short list of protocols that can actually work in a real adversarial financial environment, like the one we might see if regulators cracked down really hard against crypto, or if a large scale war broke out. Like, you would need some kind of financial system that is more robust than
But do you
centralized oracles and risk managers.
but do you think it does actually work? Because I mean, like, I was thinking about this the other day with like Tornado Cash. They Tornado Cash, like we have this idea we're going to create these censorship resistant apps that can run even in World War III or if the government comes
Mhm.
after us. The Treasury said, like, we would prefer if you guys don't use this. You know what I mean? And essentially
Uh,
their volumes fell off of the face of the earth. Like,
mhm.
nobody uses it. They sent,
Yeah,
they arrested the founders. And so like, do they actually, Tornado Cash is still up and running. It's censorship resistant if you still want to use it, but nobody uses it. So,
right.
like, are these things just temporary? Like, is this like, or are we like dreaming too big to have a global financial system that is censorship resistant? Or yeah.
I think the number one thing, I think I mentioned this yesterday with someone or on a space or sometime recently. There are two existential threats to Ethereum, uh, maybe three. But the first two, number two is eigenlayer and restaking, and number one is a lack of privacy at the base layer. And I harp on eigenlayer a lot and restaking a lot. Um, we're yeah, but privacy is even more important than that. And Tornado Cash is a perfect example because not only did volumes drop off, but the relayers dropped off like 80-90% from Tornado Cash. And it's because they don't have the kind of privacy that they need, like the operational privacy. Their addresses are public, and and the transactions are public. I think privacy at the base layer is absolutely essential for DeFi and crypto to succeed. But once it has that, yes, I think it can.
Yeah, no, like I'll push back a little bit with, like, do you, because ultimately, like, we started the conversation and talking, you have tokenomics, and it's for incentivizing changes in real behavior, right? Like,
Mm-hmm.
I want to launch this token because then I want a bunch of people to do things in real life, whether it's run a computer to secure my network, or like everybody's will launch a token and everyone's going to go use my dentist office or something like that. But like ultimately, like any digital asset is like, it's not a real thing, right? Like, you guys can have your digital assets, but it's always like, how does it touch the real world and redistribute real assets, whether it be dollars or commodities or land or something like that, maybe even our time. So like, there's always a touch point. And so if regulators really don't want you to do it, there is no escaping it in my mind. Like, there's not going to be a, like, because I feel like we're trying to fight this battle where, like, oh man, if we can just out tech them, they're never going to be able to stop us. But then it's what, the $5 wrench comic, right? Like,
Mm-hmm.
where it's like, no, they're just going to come hit you with a wrench and say, stop it, man. And
Mm-hmm.
so that's like, I always try and think, like, how much, where do we find the optimal? Because like, privacy is good in and of its own right, but like, it's, how much can we possibly use this as a regulatory backstop, or like a, let's hide our wealth from the government type thing?
Well, I think it's more about it's not it's more about hiding our everything from everyone. It's not like I like this quote about it's not what you have it's not about having nothing to hide. It's about what you want to hide from who. And everybody has things that they don't like. I don't know anyone that would just share everything about themselves and everything they're doing to everyone. Like I don't.
Yeah.
Ironically, Vitalik might be one of those people because I feel like he's like one of the most public people, and just like is living life in public. But there aren't very many people who you can look at and you're like, that person is spotless and they have nothing that they would hide from anyone. And but what I so in talking about like Monero or base layer privacy, I don't think it's necessarily about that. It's um like I think there are benefits to not having a society that's made of panopticons. And I won't go into that. What I think I'd actually like to push back on the idea that regulators can force everything to happen. So yes, like regulators were able to say Tornado Cash should stop, but if Ethereum had base layer privacy, they wouldn't have. I don't know whether Ethereum can add base layer privacy. I think they should add EIP. It's like 7205 or something like that. I'll have to look into this. It's ZK wormholes, and that's been like pushed off to the side for now. It didn't get the kind of attention that it needs. I think it would be phenomenal. That would be probably enough to give Ethereum the kind of privacy that it needs.
But don't
But
you think they would just ban Ethereum then?
I don't know. Do you? Because they have ETFs. Like they're like institutional interests on the side of Ethereum now. I don't know if they could.
Oh no, but I mean, there's tons of financial products that they can trade themselves, and or they'll sell you a financial product or something like that. But that doesn't mean you can actually do it on your own. You know what I mean?
Right.
Like,
I don't know what you mean. Can you elaborate?
well, yeah, I mean, like, if you want to buy like a, even if you want to buy like a treasury, you have to go through somebody, and
Yeah.
it just regulate the middleman. So they would
Oh,
just,
I
like, if
meant
you buy
there.
an Ethereum ETF or something like that, that whatever. Like, they could launch a Monero ETF, and you can invest in
What I
Monero. It's illegal for you to own Monero on the side, but
Yeah, I what I meant is there are people with political power that have a vested interest in Ethereum not being criminalized, even if it were to implement something like a ZK wormhole. Honestly, I don't know that that would like
No, but
that.
I don't think they would ban it straight up. Like I think they would just say like you have to KYC or something if you want in or out on an off ramp or anything like that. Like you have to prove to us what you were doing or something,
Yeah.
and that's kind of, it seems to be their MO as far as how to regulate
Mhm,
these things. It's just,
mhm. And it's that's possible, right? But there are other things that already exist that do have a level of privacy that exceeds Ethereum and exceeds Tornado Cash, like Monero. And there are other chains that I don't even think are worth mentioning that are claiming to do like DeFi smart contracts on privacy layers, like private L1s. I don't know of any that are any good. I've looked into most, and they're not up to snuff. But there are Monero is one of those things that already has traction.
yeah.
And so it kind of meets these different, and I'm not trying to shill Monero, certainly not as like an investment to anyone, but I am very interested in the truly decentralized financial ecosystem that starts to be built around Monero. So the first example of this application, of these set of applications, is Sarai. It's a cross-chain decentralized exchange. It's going to be coming out. It's like a Thorchain clone, and it has BTC, ETH, DAI, and Monero pairs. And from that, I think people are going to be able to start to build things like options, or there might be a Monero-based stablecoin that's like delta neutral, because you can use things like liquidity pools and tokens for LP shares as like components of this ecosystem. Um, so those are my areas of interest, because I think that's the most censorship resistant, and able to stand up to the kind of regulatory scrutiny that I think will happen in the next few years. But if it doesn't, like it, censorship resistance is only important once it's important. Like it's only important to the degree that it is absolutely essential. And one of the nice things about Bitcoin that I often think about is like Bitcoin might be the thing that's kept the dollar from collapsing. Like like the Fed has, like, in the back of their mind somewhere, they're like, we can't raise rates, or we can't just raise, like, drop rates to zero. They can't raise rates too much. And I'm not sure what how much Bitcoin is played into like federal regulators' thought processes on these things, but I bet it has at least a little bit, because for sure they can't just let um like they can't let hyperinflation set in and then have people run to Bitcoin. Um,
Don't think
I
that's a
might be
worry
giving
they
Bitcoin
have.
too much credit, but what's that?
Yeah, I don't think that's a worry they have.
Now, I know, I don't think it's necessarily like on Jeremy Powell's mind. It's not. But I do think that people have talked in the back rooms and made sure that Bitcoin is not going to get the kind of traction from uh, questions about the U.S. economy that would take it to like a international scale. And that's what I think. That's what I think happened with the block wars. And we could talk about all
Sure.
this, like the conspiracies that went on and things to make Bitcoin not scale, but um, not a productive use of your deep dive series.
Yeah, no, no. For a different time, we'll have to do a
Yeah,
history lesson. We can bring in a couple of people who were there. We'll be good. No, I mean, for sake of longevity in the episode, I think we have to, we can just kind of bring it back around to token
sure.
design a little bit. And where's, so if back, if somebody's looking to launch a token, what would be some of the basic pieces of advice, and what structure would you have, for somebody, let's say even like they're a US company and they're trying to start one of these things, is this something that they could do?
I don't know if I can. I don't know if I can legally answer that question. But yeah, no, like with generally in thinking about token design, the first question is like, what value does your protocol provide? And you can think about ways, and then you think about like, what value does your protocol provide and to who? And then you can think about who else has maybe a coincidence of wants. And if you can insert a mechanism somewhere to like stabilize an equilibrium between two people that have a coincidence of wants, those are your two user groups. Or maybe you pull in a third group of users that provides a service that is absent from the coincidence of wants of those users. And you can kind of think about protocol design and the precursor to mechanism design as like a giant or like a little solver where you're like this, Alice wants eggs, Bob wants milk, Charlie wants chickens or something, and then you figure out how to synthesize that, because if there's a coincidence of wants between those three people, then you can create a protocol because you have the ability to code like trust assumptions and set up incentive schemes so that each of them will give the other whatever they have. Or you could pull in a fourth person and like have that person shore up the case where one of them doesn't have the harvest that they expect to from their farm or whatever. Using very abstract or like really simple explanations, but this is kind of how I think about protocol design. And from that, you can think about where does a token fit into this, and in what way could I use that token that might accrue value sustainably without introducing price dependencies that are going to collapse it long term. And so that is the optimization within the tokenomics trilemma with the three principles of tokenomics: utility, value accrual, and economic security. So that's like the sort of the start to mechanism design and our protocol design process.
That's pretty cool. Um, yeah, no, this was great. I guess where can people find out more about you and about token dynamics?
Sure. Yeah. So we're at Token Dynamics on Twitter, and I'm official ESC as in Eat Sleep Crypto. And yeah, just reach out. DMs are open. Would love to talk to anybody that is watching this for any reason. Like if you're subscribed or watching Nick, I want to talk to you. It could be about anything. Like I just it feels like there's not that many of us. So it's always great to get on with a fellow cypherpunk and talk about the important things in crypto.
Nice. Awesome. Thanks for the kind words. Talk to you soon, Nate.